The banking index hits a lifetime high but sees some profit booking. PSU banks head higher, led by PNB and Bank of Baroda, while Axis and ICICI Bank lag.
Coal India's second quarter numbers misses estimates. However, the company goes ahead and announces a big dividend of 15 rupees per share. The street likes that, and that makes the stock the biggest gainer on the Nifty.
Hindalco, however, corrects as Novelis' second quarter disappoints. In the subsidiary in its guidance indicates some pressure on realization, while capex guidance has also been lowered.
PI Industries is buzzing on the back of a solid showing in the second quarter. Margin spikes for Phoenix Mills in the second quarter as well, while profit is higher by 250% from pre-COVID levels.
A bunch of stocks which are losing in trade despite their numbers, or rather on account of their numbers. We have Jubilant Foodworks in line second quarter as far as the revenues and margins are concerned. The stock down 5%. MRF slumps as margins come under pressure, whereas Godrej Consumer too slips after a weaker than expected second quarter.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, Mangalam, we were expecting to have a good start. We did get a good start, but from the highs, we have seen some bit of selling on the Nifty, and currently we're as flat as can be. The Nifty Bank as well went ahead, made a fresh all-time high today, but that as well has come off the high point of the day. However, in the last few days, the evidence has been you go ahead and you buy the dip and you make some money. Let's see whether or not that'll work this time around. Shilpa Raut is standing by to give us her view on the index. Hi Shilpa, morning. How would you trade the index? Buying the dip has worked. Do you believe buying this dip will work? And if you want to buy it, at what level will you enter the Nifty?
Good morning, Nigel and Mangalam. Last we spoke, I remember I was very confident that Nifty will test 18,300 to 400 zone. So we are almost there in futures today. But of course, now again, a little cautious stance because 18,400 will act as a resistance. So either you buy around 18,200 on dips, otherwise a decisive sustenance above 18,400 is a very good buy again. Likewise, Bank Nifty, it has sustained above 41,800. We should see targets of 43,000 to 43,500 zones coming soon.
All right, we take that point on the individual indices, the frontline indices, that is, Shilpa. But, you know, a lot of these stocks are doing extremely well. Case in point, something like a Container Corp, which is moving higher at the high point ahead of its numbers tomorrow. From the financials, we have AU Small Finance doing well. Bharat Forge as well, one of their subsidiaries announced an order win, and that, as a result of that, that stocks spiked to the high point. Do you have any ideas in individual stocks?
Yes, of course. AU Bank Finance, we have been recommending on in PL, from 610 zones for targets of 680 positionals. It is already doing very good. It has tested already 630. So for today, I have two buys. One is Hero MotoCo. It is trading at 2640 in futures. I'm looking for targets at 2680 to 2720 with a stop loss of 2620. Another buy is JK Cement. JK Cement futures trading at 2873.74 now. So positional targets to 3,000 and 3,030 is very, very likely. Otherwise, intraday also we can look for targets of 2930 to 2940 with a stop loss of for intraday with a stop loss of 2840.
Okay. All right, Shilpa. Thanks a lot for that. We look forward to chatting up with you soon. You've given us your calls on the index as well as a couple of trading calls. For the time being, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins us to talk about a stock that he's tracking very closely. Anubhav?
Well, our stock pick today is that of Dr. Reddy's, which posted a good set of numbers in the Q2 result. Now, company had a handsome contribution from the generic version of Revlimid, which was launched in September. The other positive drivers have been recovering in Russia business and the start of government grants on account of production-linked incentive scheme. Now, we believe as the company can sell the limited volume of generic Revlimid, the Q2 performance may not necessarily get repeated in following quarters. Having said that, we think that company would keep a focus on limited competition products in the US to overcome pricing erosion. Now, in this context, biosimilars and injectables would be the focus area. Bulk of the 1,500 CR capex for fiscal 23 is for these two areas. Emerging markets, including India, would remain the chief driver of top-line growth, We know that in recent quarters, our company has been doing a portfolio raising in India by exiting non-core brands and acquiring the assets which aligns with its long-term strategy. Now, this includes increase in the share of chronic therapies, which is currently about 30% of sales. In addition, what makes us constructive is the fact that stock is trading at 12 times CE by EBITDA for fiscal year 24, and it is trading at the lower end of 10-year range.
All right, Anubhav, thanks a lot for that. With that, it's time now to slip into a short break. On the other side, we'll have the management of DCB Bank joining us to discuss their earnings fine print and the road ahead for their business. Murali M. Natarajan will be joining in. Welcome back. Let's get chatting with the management of DCB Bank. They report their numbers. Well, the CASA ratio or the low-cost deposit ratios and the net interest margins have been doing well for the company. The slippages were rather elevated in the quarter gone by. So what's the outlook from here? We have the MD and CEO Murali Natarajan joining in. Thanks a lot, Mr. Murali, for joining in. Let's start with the slippages itself. They've been elevated for the last 6 to 7 odd quarters. In fact, I mean, if I look into the details out there, it's 3 to 4 corporate accounts which slipped during the quarter. And the ex-gold slippage ratio was just about 4.2%. So it was the gold portfolio that hurt your slippages as well. What can you give us in terms of an outlook for improvement on this going forward?
So if you look at our gross NPA and net NPA, both have improved year on year and quarter on quarter. That is point number one. If you look at our provision coverage ratio, it has gone above 70%. Okay, so those points you should consider. Secondly, we are targeting self-employed MSME, SME customers. They've gone through some really difficult period during COVID wave 1 and wave 2. Things are stabilizing, improving much faster than we expect. We expect the slippage ratio to continue to be slightly higher for at least 2 more quarters before it settles down to pre-COVID levels. Our restructured book is performing very well. We never restructured, unsecured portfolio. Our restructured portfolio is, majority of it is, secured portfolio. So the performance of restructured portfolio is also in line with our expectations. So I expect the similar kind of situation for at least 2 quarters. But look at the recoveries and upgrades. In fact, our upgrades are slightly higher than recoveries, which shows that we have a very resilient portfolio. Even if the customer do slip into NPA, we are able to kind of recover our overdues and upgrade stroke recover. And that is the reason why the portfolio quality has been holding up throughout last 2 years despite many challenges. Regarding your corporate accounts, once in a while you do have challenges on corporate accounts because these are multi-banking or consortium accounts, where if the payment is not coming forth properly, obviously 1 or 2 banks resort to NCLT, in which case till the resolution is sorted out, you can't get your payments. So we do expect some improvement in that as well in the coming quarters.
Okay. Hi, Mr. Natarajan. We have taken all what you had to say on board. Now, give us a couple of numbers. The slippage ratio is expected to remain high for the next couple of quarters. I think on a quarterly run rate, slippages are around 450 crores. You could correct me on that one. So do you expect it to stay at current levels? Point number one. And on the restructured book, you're saying, it's secured. So you don't see any worry with it at around 7% of your loans? You see an unlikelihood of these turning bad, right?
Not at all. See, there is a percentage of good book and the restructure that would turn bad. That is what should be expected because we are running a business of risk. So that is what is expected. As long as it is within the expected range, you're fine. We did not restructure unsecured loans. If I look at the unsecured loans that would have restructured, it will be a minuscule of the total portfolio. Most of our restructure is in either home loan or LAP or to some extent in commercial vehicle and SME, MSME working capital. They are performing as per expectations. And whatever slippages are coming through the restructured book, also we are able to upgrade, recover because we are dealing with a secured business. I expect our portfolio to be growing steadily. Our approach is to double our balance sheet between 3 to 4 years. Systematically, we will also be reducing the impact of the restructured portfolio. But as far as the credit cost is concerned, whether restructured or good book, everything is reflected in our credit cost.
Take that point. So if you could give us a bunch of numbers, you said you're looking at doubling your book or balance sheet by in the next 3 to 4 years. That would imply what, a 22% sort of loan growth going forward. Would you, concur with that? And you said everything will be taken care of in the credit cost. What kind of credit cost guidance can you give going forward?
I have given a credit cost guidance of about 50-55 basis points, which is our pre-COVID credit cost. If you look at our performance on loan book from 2010 to 2020, approximately we have grown at a CAGR of 22%. We grew about 7% in the 2 difficult COVID years. We are trying to put the trajectory back to pre-COVID levels. That is why I'm guiding that we expect our loan book to double between 3 to 4 years time, hopefully in about 3.5 years time, and with a credit cost of approximately 50 basis points.
Okay, all right, Mr. Natarajan, give us 2 more factors then. If you're going to be growing at this sort of a rate, do you have any fundraising plans? Point number 1. The second factor is on your NIMs. They are looking splendid. 17 quarter highs out there at around 3.8, 3.9%. What is the sustainable number we're looking at on the NIMs?
At some point, we even had a NIM of 4 or above 4%. So I would say that the business model that we have constructed since 2017 is that our NIM should be in the range of somewhere between 365 to 375 basis point with a corresponding credit cost of approximately 50 basis point. That's a business model that we are constructing, and that is what we are pursuing. Regarding capital raising, if you look at our risk-weighted assets, if we originate loan of 100 rupees, the risk-weighted consumption is not more than 60 rupees. It's a very capital efficient model. Looking at our current tier 1, and we have not added the half-year profit to the tier 1. It will be done once the audited financials are completed at the end of the year. We do not expect capital raising for at least 1 year. When we see growth that we are expecting, we will consider capital raising after 1 year.
Right, so no capital raising in the next 12 months at least. But with 22% growth ambition, I mean, I'm sure at some point you will have to consider, but that's not happening in the next 1 year. That's correct, right?
That is because the capital efficient model, if I grow at 15-16%, we will be self-funded on capital. Obviously, we are not expecting our growth to be much higher than 15-16%. So looking at the current capital consumption and also our capital efficiency, I expect no capital raising requirement for at least 1 year.
Point on board. And this 22% sort of growth that you're guiding for, can you break up, what segments will grow faster than average and which of them will lag? Because I'm looking at your CV portfolio, that's growing much slower than all other sectors of your business and much slower than peers as well. So can you give us a breakup into, what will lead growth and what is something that you're not looking at in terms of growing?
So our approach is mortgage would be our lead product. Already mortgage is about close to 50% of our portfolio. Within mortgage, home loan and business loan will be leading the growth. We'll be focusing on KCC, tractor, SME, MSME, working capital. We also have taken 2 very good initiatives in the last about 12-15 months, which is on trades and co-lending. Both are doing well for us. We are looking to add more partners in co-lending. And our agri-business also is doing quite well. As far as commercial vehicle is concerned, we are currently targeting only our existing customers. We will wait for another year, year and a half before we step up growth in commercial vehicle.
Okay, all right, Mr. Natarajan, it's been good speaking to you. You're pretty clear and concise with what you're saying. You've laid out the roadmap as well. We appreciate you joining here on CNBC TV18. Look forward to chatting up with you at the end of the next quarter. Well, for the time being, though, we'll slip into a short break. You come back, we'll continue our focus on markets and on stock-specific action. Well, the Nifty is as flat as can be, but a lot of stocks are moving around from the broader markets. And PB Fintech, that opened up well in the green after the company posted their Q2 numbers. The revenue has doubled, the losses have contracted as well in this quarter. My colleague Yash Jain caught up with the CEO and co-founder, Mr. Daya, as well as the CFO, Mr. Bansal, and began by asking them about the timeline for breaking even on the new initiatives of their business.
Cash break-even on the new initiative side of the business is a long term away, Yash. But the total burn on the new initiatives going forward will be under 200 crores a year. So I think the peak cost was in the fourth quarter of last year, when the new initiatives lost about 91 crores in the quarter, down to about 65 in the last quarter. And by the last quarter of this year, I think we should be down to about 30 to 35 crores. But there is no urgency in trying to break even on that business. So that business may not break even for the next couple of years. Okay. And, I think by 26, 27, my estimate is that business will be close to break even by 26, 27.
What is the understanding within the company, the target within the company in terms of turning adjusted EBITDA positive? By when do you see that happening? And also on the net profit side, by when do you have an estimation or a target of turning that positive?
So in Q4, we will be adjusted EBITDA positive. Once we turn adjusted EBITDA positive,
Then
become next year is going to take care of my ESOP charges. And so next year, profitable overall.
Okay. So then FY24 net profit, is that something that you're moving with?
Of course, I think we should be. We should be close to profit, or it may be whatever, right? So that should happen.
Okay.
But the interesting part, Yash, is we will be doing it with a 310 crore charge, which in 2 years' time is going to be 75 crores. So you have no change in our business. You have a guaranteed profit of about 250, 300 crores sitting there 2 years later.
One question to both of you, Yashish and Alok. First of all, before I get to the question, how much holding do you both individually have in the company at this point of time at the end of the quarter?
I have about 5.5%. And I think together we have, Alok, what about 7.5% or so?
Yeah, near about 7.2, 7.3%, I would guess. And then there are ESOP, which will get vested over time. So that will move it to about 9.5% or whatever.
Do you want to sell any more stake in the company in the next 1.5 years? Or do you want to hold on to the existing stake and whatever the ESOP adds? And the same question after that to you, Alok.
I have sold what I had to sell.
Okay.
Okay, so I am done. I don't, that's basically it.
Okay. From you, Alok?
From Yash, I think we had explained it in the past also. The transaction that I had done was mostly to take care of the ESOP excise taxation and a little bit of some other expenses. But there is no plan in near future and even long-term future to part ways with any more equity.
Yashish, you spoke about the kind of confidence which you see in the future for the company, the financials, once these small disruptions go away. If you are so much confident about that and the stock price is favorable in that context, why don't you look at something like a buyback where investors also get confidence about the management intention, and you also, the company tends to benefit out of it?
We would like to, after April 24, turn the monies that we have to the shareholders. I see no reason for us.
In what form, Yashish?
You don't know that, right? That is exactly why I have asked Mandeep. I'm not technically qualified enough to know, and I don't think even Mandeep knows the answers yet. But yes, see, in the year, I would say, so nothing before April 24.
Okay.
But after April 24, I do not see what we will do with, let's say, 5,000 crores plus of cash on the books. We might want to keep 1,000 crores. I think we have at some point the ability to forever maybe return 1,000, 1,500 crores to the shareholders every year. Now, in what form, I don't know. I don't know the answer.
Right, so that's about PB Fintech, but let's take a look at Jubilant FoodWorks, among the topmost losers in the F&O space in today's trading session. And this, despite an inline second quarter numbers, Nigel, if you just take a look at their revenues as well as the EBITDA, it was no different from what the street was anticipating. Yes, the gross margins declined by about 200 basis points, but that was understandable because of the cheese and vegetable inflation, etc. The net profit on a reported basis was lower than street estimates, and that's because of a non-cash expenditure. Depreciation came in at around 112 odd crores versus 90 crores. And the effective tax rate was 26% versus 25%. The Domino's like-for-like growth, which is basically the new metric that the company is given as against same-store sales growth, had come in at 8.4%. They've added 76 new stores versus 50 to 60 that the street was expecting. And in the conference call, they said that they plan to add around 250 new Domino's stores in FY23 itself. The first half, they've done around 135 odd. For the non-Domino's business, Popeyes is the growth vertical where they believe that this year they will open about 20 to 30 stores. But all the other businesses, which is Hong's and Ekdam Biryani, they are looking to, scale back right now to assess unit economics and only talk about all of this in the next financial year. And that is something that the street does not like. I'm looking at a couple of brokerage notes. ICICI Securities, for instance, has said that stagnant revenue per store, if you look at, the number of stores that have been expanded and over the last 3 years, the revenue, the way that has taken place, that is one of the concerns. And secondly, execution in new bands has actually utilized management bandwidth with subpar outcomes so far. Jefferies as well, they believe that the 3-year revenue CAGR for the company has been moderate 9%, and the entire benefit of price hikes that the company has taken has not translated into revenues because people have started to downtrade. So they've also trimmed their EPS estimates by about 3 to 4%. They've retained a hold rating with a target price of 580, and ICICI Securities has scaled their target price down from 750 around to 720 odd rupees. So the brokers are believing that, well, these numbers are okay in line, but the long-term trends do not indicate that, a lot of people are eating a lot more pizza. And why just pizza? The non-pizza business as well is taking a lot more management bandwidth than the results that it is giving.
Okay, all right. Mangalam, thanks for that. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.